Now friends, let me discuss with respect to the corporate taxation, and when I've already introduced the rates of taxes some time back in the revision class itself. I've already explained all these basic things to you, that corporate tax rates have undergone a good change from the assessment year 2021 and onwards. And in that particular context, first of all, the rate of tax has been the MAT rate of tax has been reduced to 15%. The old rate was 18.5%. Now it has become 15%. So rate of tax for MAT has undergone a change. Okay. Further, if the turnover of the company in previous to previous year, that means normally I call it as the last to last year, is not exceeding 400 crores, then the rate of tax is 25%. Okay. Then if you are a company which is covered by section 115 BAA, that is 22% tax rate. And if you are a company covered by 115 BA, because the option has to be exercised under that particular section, then you will not even have any MAT applications. So it's a very great advantage. So no MAT for 115 BAA companies, and there is a flat surcharge of 10%. This is one of the points that you should not forget in the tax liability calculation, because see, normally in corporate tax rates, the surcharge is applicable only if your income crosses 1 crore rupees. Otherwise, there is no surcharge. But if you are a company covered by 115 BAA, then it is a flat surcharge. That means no matter whatever is your income, there is a flat surcharge. So the tax rate is basically 22% plus the 10% surcharge and plus the applicable cess. Okay. Now, if you are covered by 115 BAA, then specified exemption deductions are not permissible. So all these are the list of deductions, exemptions, specified ones are not permissible. So without that, you get a concession in terms of the tax rate. Okay. Now, 115 BAB provisions. Okay. This is one more extra step ahead, and here the tax rate is very less to 15%. Okay. Now corporate tax rate, but this 15% of BAB is subject to condition that you have to be a new domestic manufacturing company. So basically only those companies which are incorporated after 1st October 2019, I repeat, after 1st October 2019, only then, and you have to be a new domestic manufacturing company. Okay, this benefit is only for manufacturing companies. However, if you see this 115 BAA provision, this is with respect to all the companies. That means whether you are a manufacturing company or non-manufacturing, that means all the domestic companies. Foreign companies are not covered here. Okay, so all the domestic companies, all the types of domestic companies. But this 15% tax rate, this 15% tax rate is only for new domestic manufacturing company which is employing new plant and machinery. And this new plant and machinery basic condition that I've already explained that to you. Okay, and again you don't have MAT, so no MAT provisions, and a flat surcharge of 10%. So a net tax rate will be your 15% plus 10% surcharge and plus the applicable cess. Okay, and here also the same basic condition remain as it is, that specified exemption, deductions, etc. is not permissible, and in detail I've already explained that to you in the past. Okay, now in the MAT provisions, friends, there is one more amendment which has been carried out with respect to the brought forward losses and depreciation. So normally in the MAT, that means as per the books of accounts, you have brought forward loss or depreciation, whichever is less. But for some of the categories of the companies, it is aggregate. That means both of them will be allowed to be adjusted against your book profits under the MAT provision. This is a MAT provision I'm just telling you. Okay, so any companies which are covered by NCLT, okay, that is one type where the central government has moved the petition and the board of directors have got suspended and the new directors have been nominated by the government. So this is one situation, and the second situation is the same to same, that companies resolution plan, okay, has been approved by National Company Law Tribunal, and it is, okay, one second, and it's in the previous year with respect to the NCLT. Okay, so this is one of the type of the company which is covered by this particular provisions. One more point which I would like to cover it up here is that the companies whose insolvency procedure has been accepted, admitted by the adjudicating officer under Insolvency Bankruptcy Code, that is IBC. Okay, so these type companies which are covered by IBC, Insolvency Bankruptcy Code, for them also carry forward set off in the books of accounts as per the MAT adjustment, both of them will be permitted. But this NCLT is a new concept which has been brought into, so that basically is the amendment here. Okay, so you have to remember that two type companies, one is covered by NCLT, other is covered by IBC. For these two type of companies in the MAT, you have carry forward set off of both. That means loss also and the depreciation also. Okay, otherwise for all the other categories it is these or this, whichever is less in the MAT adjustment. Okay, second point friends, under section 79 is your income tax provision. Now in computing the total income, the carry forward set off of the losses. Okay, so under section 79 also there is a significant amendment which has been carried out. That means even our income tax carry forward set off of losses of the private limited companies, because section 79 is applicable to private limited companies, technically the companies in which the public are not substantially interested. Okay, so in section 79 also there is a significant change and the amendment which has been brought into, and let me tell you that also. Okay, now these companies which are covered by NCLT or companies covered by IBC, so these two type of companies. Okay, under section 79 there is a condition of 51%, there is a condition of 51% shareholding. That means the 51% of the shareholders in the year in which there was a carried forward of the loss, and in the year in which there is a set off, 51% people, the shareholders must be the same. Now, if you are a company covered by IBC or if you are covered by NCLT, then this 51% condition is not applicable. My dear friends, let me tell you that this is not applicable. That means even if this 51% shareholding condition is not satisfied, then the carry forward set off of the losses of section 79 is also permitted in the hands of these two type of companies, that is companies covered by NCLTs or the companies covered by Insolvency Bankruptcy Code. Okay, so section 79, this is the amendment with respect to this. Now under section 79 friends, there is also one more amendment, because that is also part of the carry forward set off mechanism. Okay, now section 79. Okay, section 79. Okay, this section 79, as I already told you, but I repeat that this is carry forward set off in our total income computation, not for the MAT. Okay, so normal computation. Now if you are a company which is covered by eligible startup, if you are a eligible startup, okay, for that also section 79 has got in fact from the assessment year 2021, the entire section 79 has been replaced by the newer section. However, even the newer section, the many portion of the newer section is same like the older section, but something new additional provisions have also been introduced with this section 79. Okay, and with that section 79, one second, let me just scroll it little bit and take up that particular point also. One second. See here. Okay, so I'll take up these also together with the discussion. Okay, now under section 79, this is also amendment to section 79. If you are a eligible startup, okay, eligible startup. Now for the eligible startup, you have to satisfy either of the two conditions, Okay, so see, one of the condition is that 51% holding condition for being eligible for the carry forward set off. So 51% of the shareholder in the year of carry forward and in the year of set off, they should be the same. That is one of the condition. Okay, so that is normal condition for every private limited companies. Okay, however, if you are an eligible startup, you have these one condition or the second condition. Any one condition you satisfy, you will be eligible for the purpose of carry forward and set off, okay, of the losses which is covered basically by section 79. 9. Okay, so for eligible startup, section 79 has undergone a big change. Okay, and that is or let me the first condition is almost the same like a old condition. So or okay, all the shareholders of the company who held the shares, okay, previously you were holding, okay, in which the loss was incurred and in the year in which you are set off, all the shareholders should be the same. Okay, all the shareholders should be the same. Okay, but how is it different? See, although all shareholders are same, but these all shareholders may be holding lesser than the specified percentage, which is normally 51%. So it may so happen that between the year of carry forward and the year of set off, in between the years, there may be further issue of the share capital. Because eligible startup wants to grow, no, so they will have some more partners, there are more investors moving into the eligible startup. So when the more people move into this eligible startup, their shareholding percentage will get diluted. Okay, so the law says that your shareholding percentage gets diluted, it's okay, no problem. However, you have to hold all the shares which was your original shares. That means in the year of carry forward, whatever shares that you were holding, you should continue to hold. No doubt that a percentage might get diluted because of the further issue of the share capital is a possibility. So for the people who are covered by eligible startup, okay, so for them you satisfy either this 51% holding condition or you satisfy this condition, and if either of the condition you satisfy, then you will be straight away eligible for the purpose of carry forward and set off of the losses. Okay. Now friends, in relation to this corporate taxation, one second, let me scroll a little bit. Yeah, see some question types and where all that we can have a little bit of. Okay, so this is carry forward set off in MAT also undergone a good change, and carry forward set off in section 79 also undergone a good change. Okay, now see, this is one of the question. Okay, now in this particular question, where that particular amendment thinks that, let me just cite it up for you. Okay, now see this, as I already told you that I'm not going to discuss everything here. Okay, so this is a question basically in which the following data with respect to the profit and loss have already been given, and what are you required to do is you will have to compute your MAT profits. Okay, and all the data about investments, GST and other adjustment, basically the tax law adjustment which has already been provided. Okay, now see here, there is a brought forward losses, this depreciation business loss brought forward. Okay, business loss depreciation, which normally in the book profit adjustment, normally we will say this or this, whichever is less. Okay, now first of all, you are required to compute the total tax liability of the company, so that you will do that. So we will do that MAT adjustment and other adjustments that we will be doing. So see the solution first of all, basically. Okay, so this is your MAT profit. Okay, your MAT tax liability. Then this is your total income and your tax liability and the ultimate net tax liability. Okay, this is how it is. A very simple kind of a computation, basically full-fledged computation with respect to MAT and the total income. Okay, now what does this particular question further say? Will your answer be different if for this company application is moved by the central government under section 241? That means this is a company if it is covered by NCLT. Is that clear? Okay, and will your answer be different if this particular company, the application has been moved to the IBC and adjudicating authority under that particular clause has admitted this particular case? So this is supposing if this is a company covered by insolvency bankruptcy code. Is that okay? So in this particular situation, under the MAT, if you are covered by this, you will be eligible for the purpose of set off of both. Okay, so see the answer, how the adjustment in the answer. See, normally brought forward loss or depreciation, whichever is less. This was our normal adjustment in the MAT. Okay, because this question is more inclined towards the MAT, because under the tax law, as per this particular question, it is no brought forward losses and all that. So section 79 will not come into picture here. Okay. Now, if you are a company covered by NCLT or IBC, then you will get both. That means aggregate of brought forward loss and the depreciation. So you got adjustment under the MAT, and of course, because of that, consequential figures and the consequential multiplications have undergone a change. So normally your answer was C, brought forward loss or depreciation, whichever is less. So it was 12 or 10, whichever is less. So only 10 got adjusted in the MAT. Okay. But if you are covered by NCLT or IBC, then you get aggregate. That means it was 10 plus 12, total 22 got adjusted in the MAT provisions if you are covered by that particular situation. However, in the given question, it was printed, okay, that there is no loss or unabsorbed depreciation carry forward adjusted as per income tax assessment. Okay, so as per income tax assessment, there was nothing like that. Means section 79 had no implications because there is no brought forward losses. Okay, that's the reason in the given question the section 79 was not applicable, and accordingly, naturally, we have given that particular answer. Okay, now let's go to the next particular question. Okay, this particular Anustup Chandra furnishes you the following information here. Okay, and company is, let's see the question first of all. Income tax payable by the company. So this is a normal working that we will be doing it. Okay, so see this particular company, profit as per P&L, the MAT computation we have done. Okay, so this is our MAT income multiplied by the rate of MAT. Now rate of MAT has undergone a change. Now you already know that now the newer rate is 15%. Okay, the profit as per P&L. So P&L computation we will be doing. So your total income, okay, and you will multiply with the normal tax rates, okay, and you get the normal tax liability, and then you will compare it with MAT or normal, and accordingly you will take the decision. Your net tax liability will be how much, okay. So that will be a straightforward part of the question, okay. Now, will your answer be different if the turnover of the company for the preceding 3 years was 50, 52, and 55 crores respectively? So last previous year, the test of 400 crores. Okay, so now this is just 50, 52, and some 50 is only that particular number is there. So naturally that this particular limit that you are not crossing of preceding 3 year. Okay, so now your tax rate is going to be 25%. Okay, so that is going to be the concession in terms of the tax rate. Okay, and the MAT provision will be applicable here. The MAT provision will apply here, and a surcharge on merits. That means depending upon whether your income is exceeding 1 crore or not exceeding, accordingly the surcharge, whatever the category is applicable, accordingly you have to multiply the tax rate. So if the turnover of the company is this, then your answer is going to, tax liability answer is going to change. Okay, so if the turnover of the company is less than 400 crores in a year to year back, then your income multiplied with your MAT rate, okay, and in your normal situation, now the tax rate has become 25%. Okay, this is one of the change in terms of the tax liability. See, here it was 30%. Okay, so normal tax rate was 30%, but now because your turnover is not crossing the limit, now the tax rate has become 25%. Okay, and the surcharge is on its own merit, so your total income is not crossing the limit of 1 crore. That's the reason surcharge we have not considered relevant. Okay, so surcharge do apply, but on merits. Okay, now let's see the third part of the question. Okay, would your answer be different if the company has exercised the option under section 115 BAA? Okay, so companies covered by section BAA, no specified exemption deductions are permissible. That is one situation, and you had a concessional tax rate, that is 22%, plus the surcharge is flat 10%. So irrespective of the income, now your surcharge will be flat, and your applicable cess. And at this point in time, for these categories of the companies, there is no MAT. So MAT calculation is not required because the government has given the relief with respect to these types of companies that there will be no MAT implications. Okay, that will be the one effect. And you have already exercised the option, so the theoretical part is already complied with. Okay, so let's see that answer. No specified exemption deduction. Okay, but now you see companies covered by 115BA MAT provision do not apply, so there is no need to do any MAT tax liability calculations. Okay, now your tax rate has become 22%, but see your income figure has undergone a change. Okay, so it was 85 lakhs, now it is 85 lakhs, earlier it was 80 lakhs. Okay, but there was one deduction or benefit with respect to section 10AA in the computation. See, section 10AA benefit of 5 lakhs rupees was there. Okay, now 115BAA category companies do not get this particular benefit, so I have to disallow this particular figure. Okay, and only then I am getting a concession in terms of the tax rate. So it was 80 lakhs, but now I will be disallowing this 5 lakhs of rupees, and therefore my income will be increased. Okay, when it comes to the total income, that's the reason it has become 85 lakhs, but I am getting concession in terms of the tax rate. That is first conclusion. Okay, and see, it is a flat surcharge. My income is not crossing any limit, but in any case, it is a flat surcharge. Okay, and the MAT do not apply. So this is how the tax liability has undergone a change. If I was a company covered by 115BAA. Okay, so this is your tax liability. Okay, now let's see the next part of the question. What would your answer be if the company was incorporated on 15/12/2019 and commenced its manufacturing operation in the same year and exercised the option under section 115BAB? So if you say you want to assume that all the conditions of 115BAB has already been satisfied, okay, so that is fair enough. So like, you know, new plant and machinery and all that, all those conditions, okay, you can say that those conditions have been satisfied. Fair enough, there is nothing wrong. So that is something that you can already say. Okay, but now if you are covered by 115BAB, okay, now your tax rate is going to be dramatically low, and that is going to be 15%, 15%. Okay, so those companies which are covered by 115BAB, okay, no MAT provision, so no need to do any MAT calculations. Okay, flat surcharge, this is a flat surcharge, tax rate has been reduced to 15%. Okay, and no MAT, and accordingly the tax liability has been calculated. Applicable cess. Okay, so this is the situation if you are covered by 115BAB provision. This is how the tax liabilities undergo a change. Okay, and if you just see, I'll just tell you that this is just the economic point. Let me just tell you that now your net tax rate is coming to some 17% and they have said, government has already stated that for this new manufacturing companies, tax rate which is coming to just some 17% is the lowest or near to the lowest of all our Asian countries. Okay, so if you see Singapore, Taiwan, you see Hong Kong, you see our Indonesia, Malaysia, at all these countries, the lowest tax rate or near to the lowest corporate tax rate is now in India. So this is how they are going to have some very great fillip in terms of manufacturing in India. This is what the whole idea of the government behind incorporating such a great provision under the tax laws. Okay, so that's it. Let's see the next question. Now this particular question is more linked with the Ind AS and all that, but what are we first of all required to do? They have given all our MAT adjustment first of all. Okay, compute the MAT tax liability applying the provisions of Ind AS. So in fact this particular question has maximum of Ind AS adjustment, but in that there is no great amendment. So as I already told you, I'm not going to discuss the entire question, only that main amendment part that I want to discuss. Okay, and in this you see this particular company has already covered by NCLT. Chennai bench have already accepted the application under IBC. So this particular company is covered by IBC and application is admitted on 30th of March. Okay, so if this is the company, in the MAT provisions, the brought forward losses and depreciation aggregate figure, that means the total figure will be eligible. Okay, if any, if it is there in the question, that you have to just go and scan it. Okay, now let me check. See, this is a business loss depreciation. All this data is already there. Okay, brought forward losses and all that as per the books. Okay, so here you will get loss and depreciation aggregate figures that you are going to get for the purpose of book profit adjustments. Okay, so see, in the book profits, brought forward business loss and brought forward depreciation. Okay, IBC resolution has already been passed and accepted by the adjudicating authority. So even loss you have got it and even the depreciation you have got it. So aggregate, both of them you have got it. Both the adjustment, normally it would have been this or this, whichever is less. But because you are covered by IBC and your case have already been admitted under the IBC, in that particular case, you get aggregate of this particular figure as a matter of adjustment. Okay, so this is basically the part of the amendment, and that has already been provided with. Okay, now all other part of the adjustment is no amendment here as such. So, and not tax liability normally that we have already calculated. Okay, so no big deal. Okay, now come to this particular dividend distribution tax. Okay, now here in the dividend distribution tax, friends, first of all, the amendment, again a very good amendment by the government. Whenever there is any scheme of the buyback of the shares, okay, this buyback of the shares which has been announced after 5th of July, I repeat, announced after 5th of July, then on the buyback there will be a dividend distribution tax. But if it was announced before 5th July, then it will not have dividend distribution tax. So basically the effective date of having a dividend distribution tax on the buyback of the shares by the companies, the effective date is the 5th of July. Okay, so that is what you have to just remember it very carefully, because this is a transition period. And so after 5th of July, if there is any company which has announced the buyback, and of course it has to be announced as per the SEBI rules and all that, so it's not just like a company has announced, but it should have been announced as per the SEBI rules and all that. Okay, so if there is any announcement after the specified date, then it will be a dividend distribution tax on the buyback of the shares. Now, what will be the value on which this particular dividend distribution tax will apply? So, if you go into the technical aspect of this particular provisions, it is amount which is paid by the company upon the buyback. So, whatever is the amount minus the amount that was received by the company at the time of the issue of shares. But the amount received can be face value and can also be premium. So, this can be share price plus the premium, if at all the premium was charged. Okay, so it is just the difference that how much the company is paying back on account of the buyback, and at the time of the issue of shares, the said shares, how much did the company had collected, that means what was the issue price of that particular shares. If there was any premium, okay, take into account the premium also. This difference is basically your buyback value on which the dividend distribution tax that will be applicable, and the effective date is 5th July 2019. Okay, particularly with respect to this particular listed companies. Okay, now supposing if it was before 5th of July, that means the old scheme will apply, then there will be no dividend distribution tax, okay, for the listed companies, and instead the shareholder will have to pay tax on capital gains. So here, if the company is paying the dividend distribution tax, then the shareholders, the income will be exempt in terms of section 1034A. And it's a very natural thing, no, because then now the burden of tax has been shifted on the shoulders of the company. So the investor now will be free. That means investor will get this particular gains as a tax-free gains. Okay. So again, a pretty simple one. Okay. Now this is one of and 2 questions that we have. Okay, now just to give a little bit of a different set of experience to the students, see, this was one of the question, let me tell you. Okay, so this gentleman had purchased some shares of A Limited under the buyback of the shares, and there's some consideration has been received. Accumulated profits of the company was X amount. Find out the income chargeable to tax. So of course, if you say that this was after 5th July and it was a domestic company, then of course we will say it's a dividend distribution tax. However, I just assumed it a little bit weirdly just for the students' experience. Okay, so supposing if this particular company was a foreign company, because this dividend distribution tax is applicable only on, or you can say income distribution tax, whatever, is applicable only on the domestic companies. So now supposing if there is a buyback done by the foreign company, in that particular case the foreign companies are not liable to pay this distribution tax in India, and therefore these gentlemen will have to pay the tax on capital gains. The reason being that if the company will buy in terms of the buyback, it's as good as you are selling it back to the company. So for you it is as good as a sale transaction. Okay, so investor will have a capital gains transaction. Okay, so that is one of the assumption, a weird assumption, but just I wanted the students to give students to have that particular experience. Okay, so if the company is a foreign company, then whatever the value that you get from the company minus the cost, okay, and the difference is going to be your capital gains. If it was assuming that if this was a foreign company, because foreign company don't have to pay any dividend distribution tax. Okay, now this indexation, friends, you always have to use the latest index number. Right now when I'm taking up this particular class, this is the latest number available. Normally index numbers will be printed in the exam, so use that particular number. Okay, so don't just copy my index numbers, because they're all illustrative and the latest available at the time when I am recording. Okay, now supposing if it was a domestic company. Okay, so whatever the company has paid minus whatever the company has received. Now in this question also I had already assumed that it was assumed that the shares was issued at the face value. That means the company had received only face value. Okay, assumption. Supposing if you assume that it was with premium, then you could have said with premium. Okay, so it depends on this particular fact. So it is what the company is paying you minus what the company had received at the time, because now this dividend distribution tax, the shoulder is on the company. Okay, so this difference will be dividend distribution tax. Okay, on the dividend distribution tax. Okay, this is a rate of dividend distribution tax. Here also surcharge is a fixed surcharge by the Finance Act. So irrespective of whatever is the amount, and the applicable says this is a total tax liability on account of dividend distribution tax. Okay, now we have this another question again on a similar lines, but here it is clearly stated like, this was a domestic company. See, Indian company already had that. Okay, and under the scheme of the buyback to its own shares, okay, the cost of this gentleman's share and all that is already known to us. Accumulated profit was this figure. Okay, now find out the income chargeable to tax in the hands of Mr. X and the dividend distribution tax in the hands of A Limited. And will your answer be different if the shares purchased by A Limited is for 18 lakhs instead of 4,60,000? So here also the same concept. What the company paying you minus what the company had received it. The difference is the distributed value, and that is subjected to the dividend distribution tax. Now in this particular question, friends, one thing that you have to remember is that when it comes to the shareholder, you may think about section 115 BBDA provisions. Here the students is likely to go wrong in the examination condition. So supposing if this was 18 lakhs, so naturally 115 BBDA limit is 10 lakhs. The aggregate dividend, if it is more than 10 lakh, then excess figure is chargeable to tax in the hands of the shareholder. Normally I call it as a HNI shareholder. Normally I say like that, only for the sake of simplicity. Now see, here if it is 18 lakhs, naturally it is going to cross the limit of 115 BBDA. So will there be any tax implications in the hands of the investor, Mr. X? Okay, so will this gentleman, Mr. X, will have any complications? Because he might be receiving some very big money. Now the point here, message is very clear that 115 BBDA do not apply. Do not apply. 115 BBDA apply only if it is a dividend referred to under section 1150. Remember very carefully. So it is section 1034. Read with section 1150. Only if that is the dividend type, only on that dividend type you will have 115 BBDA implications. Now, this particular dividend is, or this particular exemption is under section 1034A. Okay, so see this is already stated here. Here, see, this is exempt under 1034A. Okay, so it is not 1034, and that's the reason this particular dividend 115 BBDA provisions will not apply. It will not apply. That is one of the key points that should be kept in your back memory. Okay, so see this amount 4,60,000. Here also I have assumed that it was issued at the face value. It's an assumption. However, if you assume that it was at premium, then at premium, whatever. The difference, dividend distribution tax. Okay. Taxable income of Mr. A will be nil. Okay, because it is exempt under section 1034A. Okay. Now, 18 lakhs company is paying to Mr. A. Okay. And this is a dividend distribution tax and all that. So naturally you are getting amount more than 10 lakhs of rupees. But still, the taxable income of the gentleman, that means the investor, the individual, is still be nil because it is exempt under section 1034A. 115 BBDA provisions do not apply. I repeat, 115 BBDA provisions do not apply to this particular situation. That is one of the main point which you as a student should remember it very, very precisely in this particular situation. Okay. Now, one more question that I would just like to take it up only for the purpose of discussion with respect to the dividend distribution done by the mutual funds. Okay. Now, supposing if there is dividend distribution done by any mutual fund which is into IFSC. Okay. So, it's a very small point, but I would like to bring it to your notice. See this 115 OR etc. provision refer under IFSC. Okay, so when I will be revising IFSC or when I have discussed IFSC, there also these things will get repeated, but I'm just telling you right now itself. Okay, so if there is any mutual fund, rather than mutual fund is not a right word, it is called as a specified fund. Okay, operating in IFSC. Okay, now for the specified fund, they have given full exemption. That means no income tax on specified fund is complying with the specified conditions. Normally, these funds have to do transactions only in the relevant foreign currency, because IFSC is basically like an international stock exchange as incentivized by the government. So, any specified fund in the IFSC will not have any tax treatment. And secondly, if they distribute their dividends to their unit holders, again there is no dividend distribution tax. So this is one of the great advantage, that any fund in IFSC no tax, and whenever they distribute their income, again no dividend distribution tax. Okay, so this is just one question that I've already said, that this is a specified mutual fund. Okay, and it is in the located in IFSC. Following information, income of this particular fund. Okay, it should be zombie fund. Okay, this is zombie fund. Okay, so it is 6 lakhs dollars foreign currency, and it has been distributed to the unit holder. All these figures. Okay, and you are required to compute the dividend distribution tax applicable to this particular zombie fund, and so fund also no taxable, and dividend distribution tax also no taxation. Okay, so this is one of the very, very big incentive. Okay, so just look at this particular answer, that amount distributed. Okay, whatever the figure subjected to, that you should have satisfied the basic conditions of being a specified fund, then no dividend distribution tax. Okay, so even no tax on the income that you have earned, and plus the distribution tax also nothing applicable. This is a great benefit which has already been provided, and these are all the relevant provisions associated with that particular fund. Okay, and therefore any specified fund in the IFSC is given a great incentive by the provisions. Now friends, a very small little amendment with respect to registration of the trust. Okay, friends, simple, say for example a trust is already registered, and having registered thereafter, if the government come to know that there is some violations of the law that have already been implemented, so in that particular case, if you are doing that particular kind of the violations, okay, so in that particular case, the principal commissioner or the commissioner by an order in writing, cancel the registration naturally because you are doing certain type of the violations. However, the reasonable opportunity of being heard has to be given to the assessee. So, after giving a reasonable opportunity of being heard, the registration of the trust can be cancelled. And a very natural thing that where there is certain type of non-compliances, and only then this particular kind of what should I say, a serious situation will come into being for the purpose of cancellation. So no big deal. It's a simple theoretical straightforward amendment. And let's go to the next point. Carry forward set of friends. I have already explained that to you some time back also, that particularly with respect to the eligible startup, now there is these conditions. So this is one condition, that is 51% shareholding condition, or second, all the shareholders has to be holding that particular shares from the year of carry forward till the year of set off. If you are eligible startup, then this relaxation have been provided. Okay, so on this we have some very good question. Okay, see, in this particular question, different year wise data has already been given to us, that originally there are 4 members, okay, and the face value profit and loss for the respective years have been given. So year number 1 loss, 2, 3 loss. Okay, then year number 4 some transaction of the shares, further issue of the share was done to Mr. Y, and in the year number 5 further issue has been done to Mr. Z. Okay, in the year number 4 and 5 there is a profit, so basically you would like to claim a set off in the year number 4 and the year number 5 as the case may be. Okay, you are required to compute the taxable income for the year 4 and 5. Naturally that we are going to do that. Will your answer be different if the company was eligible startup under 80 ISC? Okay, so the second part of the answer will come pretty important near to the amendment. So first of all, let me show you the answer, which is first part of the answer. Okay, so in this particular case, year number 4 and year number 5. Okay, year number 4 and the year number 5. Okay, see, you have a profit, then you have a current year depreciation, so naturally that will be permissible. Now brought forward business loss. Okay, now this brought forward business loss, you can do that particular set off only if 51% of the shareholder in the year of carry forward is the same as in the year of set off. Okay, so up to year number 3 the shareholding was 2,50,000 each. These are the older shareholders, ABCD. Okay, then there is year number 4, there is a new gentleman to whom the further issue has been done, but these 4 people together is holding 62.5%. Okay, that means 51% shareholding condition has been satisfied. So the year number 4 you can do that particular set off. However, in the year number 5, okay, now there is a further issue of share capital to Mr. Z. Okay, in the year number 5, and the old shareholders, that means shareholders of the year of carry forward, now their holding has been declining to some 32 and odd percentage. That means 51% shareholding condition has got violated. So in the year number 5 you cannot get that particular set off, okay, of the business loss. Okay, however, conditions of section 79 do not apply to depreciation. This is in fact no amendment, but this is basically some Supreme Court judgment, and in my normal class I already explained this into much more greater depth. Okay, so the carried forward depreciation can be set off. Okay, because loss is different and the depreciation is different, so restriction under section 79, if any, will be applicable only to the business losses and not to the depreciation. So that's the answer. Okay, but if you are a eligible startup, see how the answer will change now. Supposing if you are eligible startup, okay, so for the eligible startup there are either of the conditions. Okay, so either you should be maintaining this 51%, which you are not maintaining. Okay, so year number 4 though you are maintaining, so that will not be a problem. Now the problem will be in the year number 5. So 51% you are not holding, but all the shareholders continue to hold all the shares. This is alternative condition for the eligible startup. So all the shareholders are holding all the shares of the year of carry forward and the year of set off. Okay, so that condition is satisfied. Listen very carefully. Okay, so supposing if this particular company is a eligible startup, then year number 4th anyway you are going to get it. Reason being that 51% condition is also satisfied, all share condition is also satisfied. So year number 4 is no problem. But the year number 5, Now, brought forward business loss will also be eligible for the purpose of set-off, because for the eligible startup, now we have either of the two conditions should be satisfied, 51% shareholding test or all the shareholders should be the same. However, all the shareholder holding all the shares, but their aggregate percentage hold has declined because of the further issue of shares. So that the loss is that, okay, we are happy with that. That means your condition is satisfied. That means you will be eligible for the purpose of set-off. Okay, so this particular set-off has been allowed if you are an eligible startup, although the 51% condition has not been satisfied, but all the shares have been held, so all the shares condition have been satisfied. Okay, because all the four are the people right from the year number 1, 2, 3, 4 and 5, because this was a 5-year question, but they are holding all the shares in all these years, so the carry forward set-off is permitted if you are a eligible startup. Okay, now the situation number 3 is, in the question, would your answer be different if the company's change in shareholding pattern takes place pursuant to the resolution plan approved under Insolvency Bankruptcy Code? Okay, in the year number 5. Okay, in the year number 5. So in the year number 5, the shareholding pattern has undergone a change. But why? Because your plan was already approved under Insolvency Bankruptcy Code. Okay, and that be the reason section 79 condition of 51% holding itself is not applicable. Okay, so even if your shareholding has gone below 51%, but still the carry forward and set off will be permitted. So this is real relaxation under section 79, and the same relaxation is applicable even if the company is covered by NCLT. Okay, so see that particular answer. Situation number 3 here. Okay, this situation number 3. Okay, in the situation number 3, the company is covered by IBC. The change in shareholding has already taken place. So, but that doesn't matter. Thus, the answer will be similar to situation number 2. Okay, so computation wise, it will be the same because there is no such. That means computation wise, you will get this particular set off. Okay, so if you are covered by IBC or if you are covered by NCLT, then the set off as per section 79 will be permitted to the company. Now come to this particular TDS. Section 194M. Section 194M. Okay. This particular section 194M is one of the very, what should I say, special provisions with respect to the TDS implications, where the TDS rate will be 5% for those kind of people who are not covered by 194C, 194H and 194J. Okay, 194C is a contractual work. Okay, J is a professional fees, and one more point you just add here, that is commission. Okay, you have to add that particular point here. Okay, for individuals or an HUFs who are not subjected to the tax audit. See, normally 194C, H and J is applicable to individual and HUF only if in the preceding financial year you are covered by the tax audit provisions. Only then these particular provisions are applicable. But if you are not covered by the tax audit in the preceding financial year, if you are not covered by the tax audit in the preceding financial year, and where the payment exceeds 50 lakhs of rupees in a year, if the payment exceeds, that means those people who are not covered by C, H and J, that means logically they are not subjected to tax audit in the preceding financial year, but still in the current year your payment exceeds 50 lakhs of rupees, then there is straight away the TDS provisions, where this TDS you have to multiply 5% and that's the TDS. Okay, so basically people who are making payment exceeding 50 lakhs of rupees for commission, professional fees and contract payments, I mean, these people have to be basically some rich people only or some big business people only. Otherwise, you are not covered by tax audit and these payments you are making such a big amount. Okay, so that kind of situation the government has managed, that you are not covered by tax audit in the preceding year, and therefore normally you would have not been covered by TDS provisions in the current year. But if your payment is very big, then you are covered by TDS provisions, that means you have to do the TDS compliances when you make this particular payment. Okay, 194IA, it is basically consideration with respect to the immovable property, and this consideration with respect to immovable property now includes all the associated payments. That means consideration with respect to the club membership, car parking, electricity, water facility fee, maintenance fee, etc. Whatever the consideration for the immovable property. So suppose you are paying a price for immovable property, the price will include all these associated payments if you are making it for the purchase or for the consideration of this immovable property. So basically the consideration for the immovable property, this particular phrase has undergone a little bit of a change in terms of the understanding. But normally we say when I'm buying a property, it's only the purchase price. But even together with that, if I'm making the associated payments, the total figure has to be considered for the purpose of TDS obligations. That's all the law is trying to say. Okay, 194N is a special provision which has been introduced from the assessment year 2021 and onwards, which is TDS on the cash withdrawal. Okay, so if you withdraw a cash from a bank exceeding a limit, so payment exceeding 1 crore rupees, then there is a TDS of 2%. Now, one of the point here that you have to keep it in your back memory is that this particular transactions of what should I say, withdrawal from a bank exceeding this particular 1 crore rupees, the TDS will be applicable only on the amount which exceeds 1 crore rupees. Okay, so supposing if you are withdrawing 1 crore 50 lakhs of rupees, so TDS will be only on amount which is in excess of 1 crore rupees. That means TDS will be only on 50 lakhs of rupees. Okay, so that is a special provisions which has been applicable in this particular situation. Okay, now 194DA. 194DA provisions, friends, is basically with respect to the insurance payment, life insurance payments. So when the LIC is making a payment to its customer on account of the maturity of the life insurance policy, there was this particular section already applicable. That means this is not a new section, but there is a small change in this particular section where it has been said that now it will be 5% of the income component. Previously it was 1% of the gross amount. Okay, so if the payment is made to you, supposing 10 lakhs of rupees, in the old system it was 10 lakhs rupees into 1%, that was TDS. But in the newer system will be out of 1 lakh of rupees, how much is the income component. That means LIC will have to know that 10 lakh rupees it is paying, but how much the subscription it had received towards that particular policy. So how much is basically the income component in that 10 lakhs of payment, and LIC will of course have that particular data. The insurance company will of course have that particular data, that how much total investments they had received from the investor and against which how much the payment is. There is a profit component, or what should I say, income component. Of that you have to multiply 5%. So that way there is only a small change in the formula of the deduction of tax at source, and of course the rate of TDS has undergone to that extent a particular change, and tax accordingly have to be deducted. Now with respect to the LIC policies, that is the life insurance policies, it is not an amendment, but I will just bring to your notice that if the policy already exempt under section 1010D, if it is exempt policy, then there is no TDS. So if policy itself is exempt, that means entire maturity amount is not at all taxable. In that particular case, there is no question of any TDS provisions as such ever coming into picture. Okay, so that is your 194DA. Now friends, under section 195, that is basically TDS with respect to non-resident. So whenever there is any payment made to the non-resident or to the foreign company, then there is a TDS obligations which is required to be done. It's a very routine thing. But in that particular section, friends, at section 195, the person could also make an application to the officer to determine the exact amount of the TDS. So in other words, there was one mechanism that how much the exact amount of the tax that should be deducted. That means a lower deduction or kind of situation, or maybe no deduction in kind of situation. But if in a special situation, so you can make an application to the officer. Now that particular online application can be made now. Okay, so now this particular application seeking the determination of the amount of the tax which is to be deducted. Now these applications can be made online. So previously it was no online mechanism, but now it is just said that you can make it as a online. Okay, now a statement of TDS which is required to be furnished. Now these statements also, wherever it is required, now it is also possible that you can do the electronic filing of that particular statement for with respect to the specified transaction for which the tax have not been deducted, or the specified statement. So this statement can also be filed online now in the electronic filing. So this is basically the administrative amendment, not a big deal whatsoever. Now see this particular question, which is with respect to section 194D, that is a life insurance policy payments. Okay, in that particular case we have some different situations. Now one of the, or rather not one point, the 2 points should be remembered. One is 10(10)D provisions, that is the exempt policies. If it is exempt policies, then no tax is required to be deducted. And second thing is, there is a monetary limit of 1 lakh of rupees under 194DA. So if your payment itself is less than 1 lakh, that means even if it was a taxable policy, but if the payment itself was less than 1 lakh of rupees, then also no tax is required to be deducted. So in this particular case, you should know this 10(10)D, the basic condition under which this particular policy remains to be exempt. Okay, and that, let me tell you, actually it is not a brainer, or it is not a, what should I say, any amendment there, but because I'm just doing it is little bit valuable, so let me just take it. Okay, now friends, see 10(10)D, it basically makes it very clear that any sum received on or after, that is insurance policy that you are subscribed on or after 1st day of April 2003 but before 31st day of March 2012, okay, where the premium, okay, exceeds 20% of the sum assured. So if your premium amount is less than 20% of the sum assured, then it will be exempt. Okay, but if your premium amount is more than 20% of sum assured, then it will be a taxable policy. Only if this policy is taken after 2003 but before 2012. So between 3 to 12, that way you can say. Okay, and if you are taking the policies after first day, on or after 1st day of April 2012, then it is 10% of the actual capital sum assured. So if your premium is less than 10% of the sum assured, then it will be exempt. But if your premium is more than 10% of the sum assured, then it will not be exempt. So that is how the difference is going to be in relation to section 10(10)D. And all the policies which you have taken before 2003, okay, that is fully exempt. Okay, so for that there is no such condition. So policies which were issued by the insurance company before 2003, that is fully exempt. Okay, so that is something that you should keep it in our back memory. Okay, now see, in this first part of this particular question, your maturity figure is some 14 lakhs odd figure, but investment was 7.5 lakhs of rupees. So how much is the income component? Of that you multiply 5% and get the amount of the TDS. So this is one adjustment that should be kept in mind, that how much you have received for the investment, the tax deductor have to know, and what is the amount paid. That means how much is the income component therein, and there is a basic threshold limit. Okay, so these two things together, that you should keep it in our memory, and it should be a taxable policy. Okay. So in a second situation, okay, if you see this amount is 2 lakhs of rupees, but the premium is less than the limit. Okay, so since the premium is less than the limit, the policy itself is exempt policy. Since the policy is exempt policy, no TDS is required. In the third situation, friends, if you see, the policy is a taxable policy, but the payment itself is only 90,000 rupees, so which is less than the basic threshold limit. So policy is a taxable policy because your premium is more than 10% of the sum assured. Okay, so it is a taxable policy, but the payment, the gross payment itself is less than 1 lakh of rupees, and that's the reason there is no TDS which is required in this particular situation. Okay. Further, friends, let's see the next type of the question here. Okay, now see, in this particular case, Mr. X is having a gross turnover of 60 lakhs in the preceding financial year. So your turnover is only 60 lakhs in the preceding financial year. That is, in the preceding financial year, you are not covered by tax audit provisions. Okay, and therefore section 194M will come into picture. During the financial year, he makes the following payments. You are required to advise him. So now the limit of section 194M is 50 lakhs of rupees. Okay, and this 50 lakhs of rupees limit is only for the specified transaction. So professional fees is covered, professional fees is covered. So if it is more than 50 lakhs, then TDS will come. If it is less than 50 lakhs, TDS will not come. Commission is covered, commission is covered. Okay, so 35,000, because amount is not crossing 50 lakhs of rupees, so no TDS. But if it crosses 50 lakhs of rupees, there will be a TDS. Work contract is covered by 194M. So if it is less than 50 lakhs, no TDS. If it is more than that, then there will be a TDS. Okay, and any royalty payments are not covered because it is not a specified transaction. Although the amount is more than 50 lakhs of rupees, but it is not covered by 194M, the specified transactions, and therefore the TDS provisions will not apply. Just look at that particular answer. I think I already have that. Okay, so see, this is how the TDS will take place. Okay, if it crosses the limit, then there will be a TDS. If it doesn't cross, there will be no TDS for the specified transactions. Okay, so these three situations, C, J and H, okay, are covered. So people who are not covered by these three type sections, then they'll be covered by 194M. Okay, see the next question. Now this is a bank withdrawal. Okay, now in the bank withdrawal, friends, one of the very technical point of that particular clause which I would like to tell you, that see, this gentleman has got a two bank account. So one bank, but in the one bank I have got a two separate bank account, maybe in some different branch altogether. So I say branch 1, bank account number 1, branch 2, bank account number 2. Okay, that kind of situation. We're required to advise the bank on the amount of the TDS. Now from one bank account I am withdrawing this money, account number, but from another account number I am maintaining another account, another money. So the law makes it very clear that the aggregate figure of more than one accounts is to be considered for the TDS limit and the TDS calculation purposes. So I have to consider the total limit, account 1 also, account 2 also. So it was 50 lakhs. So that time I didn't cross the limit of 1 crore, so no TDS. Then 25 lakhs, that time also I didn't cross the TDS limit, so no TDS. But now when I am withdrawing 35 lakhs, I am crossing the limit, and thus the TDS provision will be applicable. Okay, and if the TDS provisions are applicable, okay, see, when I am withdrawing this 35 lakhs, that time I am crossing the limit. How much is in excess of 1 crore rupees? 10 lakhs of rupees. Of that percentage I will multiply for the purpose of TDS, and accordingly the bank will have to deduct the tax at source. The TDS figure is only on the amount which is in excess of the specified limit, that is 1 crore rupees for this particular clause. Now friends, let us revise quickly the procedural aspect. This particular procedural aspect, friends, the government has brought into force some provision with respect to the economic indicators. I call it as the economic indicators. That if you as an assessee pass through the test of any of these economic indicators, then you have to file a return of income. That's all this particular provision is trying to tell you. You have to file a return of income. And most of this particular test is very, what should I say, reasonable test and very reasonable economic indicators. Basically, with the help of this particular test, the law is trying to identify that you are economically well-off person in the society. I mean, that's the intention of the law. And since you are economically well-off in the society, you should have filed the return. I mean, you are rich enough, but if you have not filed the return of income, please come forward and file the return of income. Okay. Now, this is a mandatory filing test by certain person having certain transactions. So these are all criteria. Depositing an amount exceeding 1 crore rupees in aggregate in one or more current accounts of a bank in a year. Now, this deposit can be on any account. It can be cash deposit, or it can be check deposit, or basically maybe on account of your sales, maybe on account of your other revenues, maybe on account of some capital transactions, whatever. If you are depositing on any account exceeding 1 crore rupees in one or more current account, the main point here is a current account, then you have to at least file the return of income. That's all the law is trying to say. Law is not trying to tell you that you pay the taxes. Nah. You just have to file the return of income. One test. Second test. Foreign travel expenditure for self or anyone else exceeding 2 lakh rupees in aggregate in a previous year. So if you have incurred a foreign travel expenditure either for your own self or for somebody else, and this is a monetary limit. So naturally, somebody doing foreign travel, so you should be rich enough. Poor man in the country will not do that. So, and again here, this is irrespective of whatever foreign travel, for whatever purpose you are doing, whether you're doing a business travel, personal travel, whatever. But if you are spending this money, then you have to file the return of income. The main point here is you have to file the return of income. Okay. Further, electricity expenditure exceeding 1 lakh aggregate in a year. So naturally, when you are able to spend 1 lakh rupees only on your electricity bill, so I mean you should be well off. 1 lakh rupees you are spending in a year only on electricity. Okay, that means roughly your electricity bill you just divide it by 12, so some 8,000 approximately, or 8,000 plus or some odd number is going to be your electricity bill. So you must be how much electricity consumption you are doing. So considering that, I mean you are economically well off, something like that. Okay. Further, if you are claiming any exemption under the capital gains, and before claiming the exemption under section 54 to 54 GB, that is basically capital gains exemption, if your income is more than the basic exemption limit. So supposing you have got a house transaction, you have sold the house and then you have invested into the house. You might not have other incomes, but that capital gains transaction is there. So without considering exemption, if your income was more than the basic exemption limit, then you were to file a return of income. I repeat that these provisions actually doesn't say that you pay the taxes. The law only says you have to file the return of income. That's the only test which is there with the help of this particular provision. Further, the government is trying to push e-assessments, and with that the appropriate rules and modifications which the government is going to carry out. So normally the intention of the government is to have electronic assessment, faceless assessment. That means you don't have to go and directly face the assessing officer. Okay, so you have to do all electronic transactions for the purpose of assessment, and all that is the idea of this particular but appropriate rules, notifications have yet to come on this particular point, and when it comes, we'll see how this, basically it's only the procedural aspect. Okay, now see this particular question. Yeah, seeing this particular question that we already have these different persons have got the different transactions, and accordingly you have to decide whether the return has to be filed or not. Okay, now Mr. A is deposited in the bank account 10 lakh rupees every month on account of his cash sales. Now on account of the cash sales is just a question data, but it can be a deposit on any account. Okay, so deposited 10,000 every month, so 10,000 into 12. Okay, so you are crossing the limit of 1 crore, and are you depositing in a current bank account? Okay, that means are you depositing in the current account? Yes. So you have to file the return of income. But you see Mr. B deposited in the savings bank account 12 lakhs rupees on account of cash sales. Okay, so it is savings bank's account, and that's the reason this particular provisions of filing return, because this condition is applicable only to the current account and not applicable to the savings account. Okay, so accordingly you have to keep on updating the answer. Okay, see Mr. A should file the return. Mr. B, there is no need to file the return. Okay, you understood that? And all that explanation in the answer I've given to you in the, and I already told you, friends, this is only the revision class, so we are not solving every answer into detail, but I'm just giving you the highlights of all these things. Okay, now Mr. C has traveled with his family and with his 2 sons, and expense per head is 51,000. So 4 people, he himself, his wife and 2 sons. So 4 people, so 4 into 51,000. Roughly you are crossing the limit of 2 lakhs. So you will have to file the return of income. However, you have debited this to the capital account, that means showing that as a personal drawings, that is hardly matters. Now Mr. D, foreign travel for his business purpose. That is business purpose, expense is only 80,000. Okay, so not crossing the limit, so you need not file the return. Okay, see, Mr. C has to file, Mr. D is not supposed to file. Okay. Now, Mr. E, foreign travel for his business purpose, expenses this figure. So very high figure, so you'll have to file the return of income. Electricity bill is 12,000 per month. So roughly 12,000 into 12, 1,44,000. So that is crossing the limit of 1 lakh. The return filing is required. Now, capital gains on the sale of his residential house is 36 lakhs and has reinvested the money into another house, 40 lakhs. That means full amount logically you will claim the exemption under section 54, and assessing officer in the course of the assessment has allowed the exemption fully, and thus no capital gains was chargeable to tax, and he had IFOS of 12,000. That means the other income is only 12,000 rupees. So before the exemption, so naturally your income would have been 36 lakhs. So more than basic exemption limit. So you will have to file the return of income. So this test is only for the purpose of filing the return of income. Okay. Now, one thing that I would like to just bring it to your notice, that is IFOS is just 12,000. Well, normally if you will see your net total income is less than basic exemption limit, but before the exemption the amount is more than the basic exemption limit, and that is the reason you will have had to file the return of income. So E has to file, F has to file, and G will also have to file the return of income. Okay, so they will have to file the return of income, and all this explanation I have already given it to in our formal answers at the respective places. Now, small some of the amendments, let me just take it up. One is with respect to the penalty. Okay. Now, see, under section 270A, there is a penalty if you have not filed a return of income, and detailed calculation I have done it in the regular class. So, see this 270A penalty for not furnishing the return of income. Now, the situation was that supposing if the reassessment notice had come and you had not filed the return of income, but you are filing the return in response of a notice of a reassessment. So, this situation will also be attracting the penalty now. Okay, so basically the government is saying that you hadn't filed the return. No, you are just coming and filing the return because you have received a notice from the government on account of the reassessment. So, it shall be subjected to the penalty as good as the original return which you are supposed to file, you haven't filed the return of income. So any such filing of return, the first time filing of return, but in response of the notice of the reassessment, okay, then you will have to be subjected to the penalty provisions, just like as if you had not filed the return, something like that. Okay, the provisions will be applicable. Secondly, friends, there was a prosecution provision that if you failure to furnish the return of income, then you could be prosecuted. Okay, where the tax evaded old limit was 3,000 rupees, but now the limit has been revised to 10,000 rupees. So the prosecution can be launched for non-filing of return, but only when there is a tax evasion. Now the limit has just undergone a modified change. Now, friends, interchangeability of PAN and the Aadhaar. Now, variety of the provisions have been amended, whereby which instead of a PAN number, you can provide your Aadhaar number as a substitute. So basically now, in majority of the sections, majority of the provisions, wherever the PAN was required to be quoted, instead the Aadhaar number can also be quoted. So this kind of amendment which has already been carried out. Okay, so in many situations, the Aadhaar can be furnished in lieu of PAN. Okay, it can be furnished. Many such situations. Okay, now it has been clarified that there will be a penalty if you fail to quote a PAN number or even an Aadhaar number. So very natural thing, no, because the interchangeability, you quote a PAN number or you quote an Aadhaar number, then there is a penalty which has already been provided in this particular situation. Okay, so these small penalty changes which has already been effected. Okay, now submission of a statement. The specified financial transaction, there was a submission of statement as per section 285BA, pure procedural aspect. Okay, now there is no threshold limit of 50,000 rupees. So specified financial transaction, normally in the old system you had to report it only when it exceeded a limit, but now there is doing away with. That means there is no condition of the specified limit as such with respect to the specified financial transaction when you have to submit the a statement of the financial transactions. Okay, now statement, if it is defective and if it is not rectified, it will be deemed to be inaccurate information furnished. It's a very natural thing that if it was defective, you have to rectify it. You haven't rectified, so it is as good as inaccurate details which has already been furnished. Okay, then the penalty for the failure of 285BA, now there is to all the responsible persons, the penalty limit is 50,000 rupees. So any failures of 285BA, that means non-submission of these financial statements, there is a hefty penalty which is applicable. Now the security transaction tax has undergone a little bit of a change, okay, with respect to the option transactions, but it's just actually not, we are not very much concerned with that, but it is there, so I just bring it to your notice. Okay, the relief of section 89 is to be considered for the purpose of advanced tax provisions. Here also many sections have undergone a change, but the theme is just the same, where see, normally we say like that whatever was the tax liability, okay, minus the TDS minus the reliefs or the tax credits, okay, this is your net advance tax required. Normally we said like that. So tax liability minus TDS minus reliefs, a specified rebates or tax credits will be eligible. The net figure is the advance tax required. Now, if there is any relief under section 89 with respect to the salary accrued in a particular year, received in a particular year, the very special adjustment is already there. Now, with that kind of a relief, will also have to be considered for the purpose of advance tax calculation purposes. So, I mean, if you have this particular relief of section 89, then to that extent, you have not to pay advance tax, because it is something like a credit that you are anyway going to get it in terms of the relief under section 89. So, in fact, it is a more of what should I say, streamlining of the provision. So, this relief is also eligible for the purpose of tax adjustment while doing the calculation with respect to the advance tax payments to the government.